It's been a minute, but hopping on here for a quick video. Determining bias. This is something that I struggled with for a while until I really kind of started finding out a couple tips maybe and random things that I would say help. You can see we're on the hourly chart right now, and hourly charts where I'd stay most of the time for trading on the 1 minute. It's a good it gives you good signals for smaller term moves because you can you're most of the time we're going to be trading within 1 hourly candle, maybe 2 or 3 if you're really holding a trade for a long time to a target. So, or you're holding a runner or something. So you don't really want to go higher than the hourly because it's just not really that relevant for the 1 minute. Especially if you're talking about daily or something, because like the daily you're talking about a move over, like maybe on the daily chart you're going to be seeing a move for like the coming week or month. So it's not giving you enough detail, and I think the hourly is the perfect kind of medium between that. So the easiest way I'd say to find bias. So when we look here, for me, finding bias is entirely hindsight. So what does that mean? That means that I'm looking at what we have traded off of and what we could trade into. So when we come here, say at 2 a.m. on Tuesday, and we have this hourly candle that these bodies respected this gap and went back up, didn't take out the high, but went back up. You can see that when we disrespect the gap, both of these, we came right here and we traded into this. We came a little bit farther into this, and then we went back up. And we can see here, this hourly candle at 4 a.m., when we disrespected this gap, we came back up into this gap and this gap above. And then same thing back down. This is quite a small gap, but we disrespect that, 7 a.m., and we came back down into this low again. And then when we disrespect this gap here, it would be intra this candle, but you can see that we came down into this gap below the next point of liquidity, because that's all it's moving. It's moving between from liquidity to liquidity. So you could say that after this candle's done, it's the 4 a.m. candle, so at 5 a.m. when this opens, you can assume that since this closed here, it would be a good target for a price to go to this next gap up here at 102. That's just a safe assumption, essentially. And when you really look at this and like look at all of the gaps in hindsight, any significant gap, so like, okay, if we looked at this gap, when this gap got inverted on this candle, we came back, we traded inside of it again, and then we came up to this high before taking out a low or disrespecting this gap. And we can see that pretty clearly. We came up over the weekend, basically Friday and then Sunday and then Monday pre-market. You see the same thing down here. Now this is a huge candle, but when we're looking at this gap right here, we're respecting it the whole time, and then when we disrespect it, we take out this high right here. And the same thing with this gap, this obvious gap that we respected here, when we take it out with this candle, which also disrespected this gap, where did we come to? We took out this high as well. And I'm going to assume, without even looking at this candle, the 10 a.m. candle, that we came out, we took out this high, and then we had a small reversal to come back down and get some liquidity here before then continuing up in the later afternoon session. Right here. Obvious gap. Obvious gap. Inverted. And we came down and we hit this low on the next candle. Inverted it right here. And we hit this low on the next candle. I mean, and then if you actually draw it out, before inverting the gap, we also came down and even hit this next low and this low. And we came down and kind of traded off of this fair value gap down here with the wick. So yeah, I mean, I think it's just something quite helpful, bias determining, to point out. And I don't think I mentioned it so far.